Good morning, everyone. Happy Monday. Welcome, Tim. Very excited for this week. How are you?
Hey guys, hello. Hope everyone is fine. Really appreciate you tune in, or if you tune in later. So first
Yeah.
time this series on MenthorQ, streaming it out to the world, and let's see how you people enjoy it, or maybe not.
Yeah, so I'm very excited because I think we've been kind of working together for just over a year. So you were one of our first users, and then obviously you were providing a lot of like really interesting content on the macro side, and you were part of our initial macro trading room, and you're still part of the group. But today we're going to kick off this series where every Monday at 8 a.m. Eastern, we're going to like connect here live on all our social and provide a macro update for everyone to kickstart the week. So obviously it's a very good time before the market opens. We're going to look at macro trends, macro catalyst, and provide a lot of like really valuable insights, as well as showing you how to leverage maybe some of the models that we provide to macro. Before we go into the presentation and before maybe we give an introduction to you, Tim, on your experience, I'm going to just show the disclaimer for a few seconds.
Yeah.
All right. So I'll pass it on to you, Tim. And maybe for those who don't know you, of course, many people do because you've been very active on Discord. Maybe just give a brief introduction of yourself, your experience, what brought you to the macro side, and then obviously we can kickstart the presentation.
Yeah, right. Let's get on to it. I'm with MenthorQ like 1 year. In 2 days, it's 1 year actually, 15th of January last year. I joined the team over there. And as Fabio mentioned, I joined the community because in 23 there was a lot of talking about gamma options, data market, blah blah. I'm sure you're all aware of it. And it was a really comprehensive service. So I never regret that. It's great. I use it to the day. I use it all the day to do the technical analyst side of trades, of ideas. And yeah, trading macro is like a part of my life since when was COVID 20? It was like 21, 20-ish, because I never understand back then how could oil prices be negative, right? And then I dipped into this giant rabbit hole, which is huge and enormously deep. And I never made it out of there. I'm still stuck, which is good sometimes. I like it. I also have a few intraday trades if there is a possibility that I can jump on. Like last week, later you will see it in the short presentation, how this actually can be done with the data that we are providing and with the ID behind it. And yeah, for the lives that we are scheduling, as Fabio said, 8 a.m. every Monday, so it's weekly. I try always to give you a little bit of a review from the last week, what happens, because if you are a technical trader, it's maybe interesting for you how things can be connected, how you can think over things actually. And then we also have a look in the upcoming week, right? Economic data points or something like that. And then I also try to show you, like different markets. I'm trading, mostly commodities and bonds. Also sometimes ES futures. But there's so much stuff out there. And since we are providing a ton of data, it's always cool to generate new ideas out of it, but more later on that. And sometimes, if we manage it, we are trying to bring in guests, right? People out from the industry. So we will have a chat with them. But yeah, since it's the first live, let me cook a little bit over there. I have to reach out and build the contacts and ask the people. Some are shy, some are not. And yeah, in the future, there will be a lot more. So yeah. And if you have questions, you can always pop them in here. We will go over it. Or if there is something in the market that moves and you didn't understand it right, or yeah, we can talk about it and try to find a solution. I'm not the one of the trader that always says this happens because that has happened. That's not my style. Sometimes the market does things. So, all right. So it's up to me, Fabio, right? So you are just watching and enjoy the time. All right. So that's the first one here, and it would be really nice if you people could type in if the resolution of the images is good enough for you that you can see it, right? I don't know if you're watching on mobile or desktop, so I always have to little bit tilt my head to the right here because it's on another screen, so don't get confused by that. And we begin with a little short review of last week. So the reason you are seeing this chart over here, it's looking good on the laptop. Thank you, Daniel. Hard to see the titles. Yeah, I will mention the titles. That's not a problem, right? Just go over it. That's a market snapshot from last week, right? So the beginning is the Monday over here. I'm focusing on some ETFs in the US sector. Our first review is pretty hard tilted to the US market. And the main thing you can see over here in orange is the RSP ETF, the equal weight SPX. Below there is SPX. In green, Max 7s. Below there, Qs. Then in lilac, second from the bottom, IWM. And last one is ARC. So, and as you can see, I also highlighted two events of the week. The first one was the JOLT report, and the ISM report on Tuesday, and of course the NFP from Friday. The main reason with this chart I want to map out is the current story that the market is playing, right? It's all about labor markets, labor market data in connection with rate cut expectations. We will go into this a little bit later. Now let's focus what the market has did. Obviously, this chart shows weekly performances. And as you can see, overall in the market, we are shy down like 2.5%, right? Shown in RSP, which is equal weight SPX. So every stock in it takes on an equal weight basis, not like in the real SPX where market cap moves things more or less. I always use this to map out some divergences, what's leading the market, what's lagging behind. And if we can see here, JOLT's coming in higher. On Tuesday, you have a downtrending day, which got a little bit covered in the end. Then the rest of the week was pretty dull. That's Wednesday here in the middle. Tuesday was a holiday because of the funeral from a former US president. And Friday hammered the market down with a way, way, way too high NFP for market expectations. I mean, it would be a good thing, right? Because a strong labor market always shows you a little bit that the economy is doing good. But I mean, since the last FOMC in December, I'm pretty sure you all know that the market is penciling in fewer rate cuts over the year of 2025. So risk assets like those are here on the chart having kind of a bad time. And the reason I look at this specific sectors is if you see the ARC ETF, right? The famous Katie Woods ETF, that's pure risk on stuff. Those are assets with high beta, means they are moving a lot. Okay, they are risky. some say it's trash, which is allocated in the ETFs. And on the other hand, you can map out if stuff is doing good in terms of percentage revenue and ARK, people are more to the risk side. So with ARK down like 5%, 6% over the week, we are not in a risk on scenario, right? That's the first thing. And the reasons behind it, we are kind of, have talked about in the last 3 minutes. So key takeaway here, elevated volatility due to some economic data. Both of this will get a little bit more important later. But yeah, let's pass it on. That was from Friday, AES trade. Just want to show you guys over here how we doing the work for our intraday community. I'm more in the camp of trade just intraday if there is a highly chance to get a trade where I can make some money. I'm not jumping around in the markets all the day or all the week, just if the stars are lining good. Let's say it like that. And yeah, it's maybe a little bit small over here, but left-hand side top is the ES chart, which brought in some volatility and downside to the NFP. I then later choose to short this market. And on the right-hand side, the upper pane over here, that's kind of how our data looks on the dashboard. And just mapping out gamma pockets in the market. They are over there because of open interest from options. And if the market moves, those gamma exposure got bigger or smaller. I then mapped out the possibility of a bottom for Friday, which I took in here at 850, 860-ish. That's in ES, this big red chunk over here. And on the left-hand side, down this pane, this was the trade that fitted into the narrative over here. Red circle that got stopped out a few times, but then scaled in, had a nice short over here. It's purely an intraday play. All this stuff has aligned with volatility. On the right-hand side down here, there's a VIX chart from the Friday. And I also do the analysis in VIX like they do on pretty much all the other stuff that I want to trade with the help of option levels. I then make my little drawings down here, like if VIX in the yellowish pane be flat, wait for direction. If VIX in the red, no longs. If VIX in the green, no shorts. Just added this here to show you guys that you can work with the data intraday. We have a lot of traders in the community trading intraday, NASDAQ or yes. So some have a different approach, but that's basically mine. We had 2 times this week where exact the same setup has mapped out. So also intraday data are welcome, not just macro insurers like me. And we are slowly going into this week. I'm pretty sure you guys have maybe heard it or read it on media. Bond yields are pretty high. We have like nearly 5% on the long end, 30 years. That we have also over 4.7% for the 10 years. The short end of the bond market is in theory, right? Pricing in small chances of a rate hike for the next 2 years, because as you can see down here on the left-hand side, US O2 yield is above the actual effective federal funds rate, which is the rate determined by the Fed. And we are trading above this, right? Very interesting. So from a technical side, I would say that's some overshooting in the short side of the bonds. Because think about it, a rate hike in 25, why, right? We had a 50% basis point cut in September, where we can argue about it if it was a mistake. I'd watch tool above here that you can see coming in. And main reason behind this is also uptick in inflation on the left-hand side. Came out from Friday, United States University of Michigan. They have surveys, 1-year inflation expectations. A pretty nasty uptick here. So, but it's just a survey from people like you and me. They're getting a phone call and then they ask them about their inflation expectations over 1 year. But the market is watching this stuff, of course. On the other hand, it's soft data, as we say. So you have to always map this out with inflation swaps if you have access to it. But they are ticking high as well. I think like on Friday, the 1-year inflation swap on Bloomberg was like 2685, 27. I mean, it will be important this week. Because this week we have a lot of economic data. And that's then the other part always of our little macro update on Monday. So the last few slides have been a little review from the past week. Now we are going into the next week. And I always start with economic data. If we have important stuff, obviously Wednesday will be most important with the CPI report. Okay. Then on Thursday, retail sales. Oh, and tomorrow PPI, of course, but more to this later. And if there are important earnings for the market, I will also add them down here. And I will speak a little bit about what tickers I'm watching and why I am then watching. Okay. So Tuesday, producer price index, of course, big inflation topic. Will hit the markets tomorrow. And on Wednesday, CPI. The main takeaway here is some people are sometimes surprised by the numbers that are coming out. I have learned it this way. On Wall Street, all the analysts, they are running models to forecast this number, right? And these models are really comprehensive. So there is always a little bit room for margin. Like if inflation has month over month will come out with 0.3, it's very, very unusual that the actual number is like 0.5, right? Because the models that are forecasting this stuff, they are so good because they evolved over the time, how they calculate inflation in the US. It's mostly a fit right there. And then the numbers are coming out. And then I get sometimes questions or DMs, hey, Tim, inflation is a little bit higher this month. Why is the market not down? Why is the market up instead? And I always say, because they know, right? Wall Street isn't stupid. Sometimes they are maybe, but in terms of numbers like this, they spend millions to get this right and sell their research to the customers and say, hey, next week inflation will be coming in higher with 0.1%. You should buy this at this inflation swap, or you should hedge your portfolio with blah, 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 ABC, whatever. So you only have to trade that you can map out with your macro expectations if those numbers are coming in way, way higher or way, way lower. So that's like in the last 3 or 4 years, it happens like 2 out of 10 times that they are off with their estimates. All right. Just a little story behind that. Yeah, and as you can see for Wednesday, our main market event, the core inflation rate, I'm mostly watching this. Core inflation is a little bit more important, right? The forecast is 0.3 higher, like the last 4 months. That's up to you what you're saying. To this coincidence that the number is always so little tight and a little small, but yeah, that's the state of the market. And yeah, that's obviously the main thing if you're an equity trader and if you need volatility intraday to make your trades like me. I also will just trade the Wednesday in equities. But yeah, then the week is pretty usual as every second week of the month, Fed speech. Sometimes it's worth listening to them, but 80% of the time it's just blah blah. Sometimes they don't know what the other FOMC members are talking about. Some of them are pretty good and have actually a really good idea how the US is going. But yeah, on the other hand, Friday, looks pretty boring. And then, of course, you have those weekly numbers that you have all the week, like jobless claims, or if you're enjoying oil, but we will get to oil later, inventory numbers from the API, and Cushing inventory numbers from the biggest oil inventory housing in the US. So, earnings. This week is earnings kickoff. And usually banks are reporting as first. That's some sort of tradition, I have to say. And what I do always there is go with the earnings calendar. There are a lot out of there, and then I'm just watching the most important stuff, right? So on the 15th, as I said, the banks are kicking in with JPM, Citi, Wells Fargo, and Goldman Sachs. Small tip from me, if you're watching those earnings closely, you have always a few opportunities to trade them. From the stock side, we will go later on an idea for Goldman Sachs. On the other hand, some are weighted pretty high or pretty low in the index, right? And if you have a stock like United Health, it's the second biggest stock of the Dow Jones Index. The Dow Jones Index is price weighted. And it sometimes can add a little bit pressure to both sides, right? Depending on the outcome of the earnings and what the market is doing over there. And on Thursday, then we have TSM. It's the first semiconductor stock that reports quarterly. So the main takeaway here is if TSM is doing good, what is doing NVIDIA and all the other semi stocks, right? That's a so-called sector play. So you can map out what the stock is doing. Maybe the others doing it in the same performance, up or down. Also think about the ETFs that you have here for semis, like SMH. They are of course heavily weighted with those stocks, so it could affect the performance. That's a snapshot from SPX, because I also want to show you a little bit of the data bits that we have over here and how we changed from Friday, closed from Friday, mapped this together with volatility, with VIX. So on the right side here, there is gamma exposure for VIX options. It's not a surprise that 20 is pretty positive in gamma exposure. Could mean two things. The first thing is the spot price is really close to 20. So the options are over there have the biggest gamma. You also have to map this over here a little bit with open interests. What is actually in the market? What has traded? Calls, puts? Are they sold? Are they bought? That's stuff that matters here the most. But the main takeaway here is, on the other hand, SPX is trading in quite big negative gamma chunks. So that means we are pretty hedged, or let's say speculated to the downside, because you never know who is a speculator and who is a hedger, but they are all equally important, right? Because those negative gamma chunks, they will bring up volatility a little bit. So on the other hand, think of market making. Don't want to get into that much because it's a huge topic where you can talk like hours or days about it. And yeah, the market maker has to be delta neutral. They have to hedge this out. Maybe they have to sell further SPX contracts because all the options here, and if we move further down in spot, they are gaining more deltas. So they have to hedge this out, selling SPX, selling futures maybe. And this stuff in combination with a VIX that's maybe popping higher above 20 can cause more volatility. So for more downside, maybe, right? The last thing about what's going on in markets and what is the current story is down there. Just a few SOFR contracts, because I also trade SOFRs, so secured overnight funding rate futures. And long story short, they're pricing in a pretty hawkish stance from the Fed, right? It's kind of the same with the bond market. Prices go down nearly every session. I like the contrarian plays here. If it turns out to be way too hawkish, it's basically the reverse situation that we had in summer last year, where the market was way too dovish, where we are pricing in like 5 or 6 cuts for 25. Now we are pricing in just 2, right? Because we are doing actually way too good. And the market says, oh no, you won't have your 5 or 6 cuts in 25, so just 2. Just SOFR contracts are going down as well. That's a small piece of the dashboard that we are providing with the MenthorQ website. It obviously has a ton of data, right? And we cannot go over it all because it's pretty much. But that's Goldman Sachs out of the close from Friday. And with this information, I knew it's always kind of a gamble to play earnings, but I know a lot of people are liking this because revenue can be pretty high. And in theory, if you design your options trade pretty good and you have your risk always in the mirror, the risk is kind of limited. So we have a lot of people that are before like 2 days or a week, they are going over this, and then they maybe do a little earnings play over here. It has to fit in the market as a whole thing, right? I wouldn't do this if the market is down for like 1 or 2 weeks. It's way more rewarding if the market shows you risk on and risk assets like stocks are doing good. But just want to show you over here, like I showed you for SPX or ES, we have also net gags or explorations, so all down the options change for individual stocks like here in GS. Then you can look over different expirations for Goldman Sachs on the right-hand side, the upper pane. And we have a 5-day swing model for stocks, ETFs with, I think it's prosperity. We can't share the calculation here. But this model shows you some sort of ranges where you can play the contrarian side of a trend. Skews 1 month, $25, term structure for options, and then the easy stuff like open interest and what has been traded for the specific ticker. And pretty cool thing, what I'm always watching, because we have it also for several commodities, ETFs, and the stocks is the option matrix. That's the little table over here, which shows you stuff like gammas, deltas, open interest, expected moves for each expiration, right? That's why there are so many dates included here. And you can always use this for, like changes in open interest, in deltas, in gammas. Is there volatility to the downside if you have negative delta and negative gags? Or is the one negative and the one positive, which stands for fuckery in the market, right? Where you can expect choppy things and weirdness coming in. And then some basic informations. How is IV? How are gamma conditions? All the stuff like that. So just want to show it here. If you fancy earning trades, we have a lot of data where you can over it. Also, there's always someone in the community that has a little bit of insight or can give you advices. But yeah, just to build the bridge between why I mentioned earning dates a few slides earlier and why we provide the data for this. I also try to cover as much as possible markets for the week. Obviously, it's always a little bit time consuming to go over everything. So this time I brought in some commodity trades or commodity ideas. So on the upper left-hand pane, there's corn. These are all futures, right? So the upper pane is the corn future. A little bit below in the middle, CL. And down there is natural gas. For natural gas, I showcased over here the 5-day swing model for the UNG ETF, the same one for oil in the USO ETF, and if you want to dip your toe into ag futures, well, ag means agriculture, okay? NetGags, all expirations for the current corn future. So what's the story here? Okay, let's begin. Corn futures had a pretty big Friday up move. Why? Because 12 a.m. Eastern, 12 a.m. Eastern, the waste report get published. So that's like, it's like a balance sheet of grain production, right? For every grain that's in there. So obviously you need a little bit of insight to map out the trade over here. On the other hand, we have a little bit of data that you can use, right? So you can map those things out and you can work with volatility for the current future contract. And the outcome of this is always a little bit dicey because you never really know about these reports, if they are bullish or if they are bearish for the futures. But I just want to highlight that we have the data over here. And if you are seeing this massive uptrend and you're sitting not in the train on the long side, what should you do? Maybe can you fake this move? Can you think for corn futures 470 aligns with a technical point that I mapped out in my chart, a daily high from last year, May. is it maybe the end of the trend, right? So the same goes kind of for UNG and the net gas future down here. It was tomorrow in the morning in the open, again up 6%, I guess, net gas futures. It's kind of related to the current weather situation in the US with the Arctic blast. So it's the main takeaway for NG traders or people that want to trade NG. Weather is always pretty important to watch over there. Think of heating, right? Think of energy. People want warm homes. And how do they get the energy? Well, probably from a gas power plant that's burning gas. If this demand is high, hedging will come in the front month because the gas demand is pretty high, and every corporate that sells gas, they have to hedge their exposure, right? That's the main reason you have this pretty strong trend in gas right now. And to build a bridge for options data, UNG is natural gas Henry Hub ETF. I would not advise you to trade this if there is not enough, let's call it juice in the future, because the main problem of the UNG and the other commodity ETFs, they are usually suffer in performance when the future is about to roll over. You can easily watch a UNG daily chart, like year to day or 5 years, and compare this with an NG future chart. And the UNG ETF has a miserable performance. It only works if there is a story and if there is big volatility, like we have since 1 week in natural gas. And if you look a little bit for the 5-day swing model over here, there's a recent high on the upper risk trigger, which later then gets sold. And the last red bar kind of touches the lower band over here. Those are plays that you can set up. If there's a story behind, I would do it always with a story behind. If I see, Arctic blaze is awaited for the US, and also the UK is suffering from really cold weather this time, and that's some sort of stories that I watch all the time, and then I go over to the technicals and made my trade over there. But as we can see, the 5-day swing model works pretty good here. The swing model doesn't need a story like I did. It's just technical. But that's stuff I would set up. And that's basically macro trading, right? You're betting on an event that no one has on the radar so far. If you are really professional in your market, but that would also mean you need a lot of knowledge about natural gas. And the other trade is then, okay, you read something, you maybe have a subscription for a weather report, and then you think, okay, there's maybe a trade in it, let's see. This is how I do it all the time. The kind of the same goes for CL futures, like here in the middle. CL right now. 77. The March contract right now, already up from yesterday, like 150. So CL. It's also a part of short-term demand versus supply. That's the reason you see this massive uptrend since the beginning of the year. It was like, let me cook. 2nd of January. CL broke out of this massive range that was online since 15th of October 24. And the story behind here is it's a common consensus in the market that we will suffer oversupply in oil markets in 2025. And then how futures work, if the term structure is in contango backwardation. It can bring in volatility to front month, because if everyone says, we will have a surplus in 2025 for oil, and then the situation changes and oil demand kicks in higher, it's the same story like in NG. Producers have to hedge, right? Because they maybe have a little bit more oil to sell in the future. So they have to buy in more for the inventory. And if they have to buy more, they also have to hedge this out with futures. So it will bring in volatility to the front month, what it did 2 weeks ago. And then you have the speculators jumping on the bandwagon long. Then you have people who are short, they maybe get squeezed out, get covered. And all this is creating volatility in commodity markets. And a little advice here, if a commodity market is trending 10 trading days, and you have already a yearly performance of 5% in oil, don't play the hero, right? Don't be the first one in the short, because you are the opinion that's not fundamentally backed, because commodity markets, they can run pretty hard and pretty long. So be patient with the shorts over here. I'm doing the same. No position over here, not yet, but maybe in the future. All right. I think that's all. We covered some stuff for the week. You guys know or should know what to watch, what not to watch, or what could be important for the week. And I also showed you a little bit of MQ data. So yeah, if anyone has a question, pop in. Do it now.
The questions. Thank you very much, Tim. That was awesome.
Yes.
So while we wait, we haven't got questions. So please, guys, if you have any question for Tim, share it here. I want to share some of the events that we have this week. So I think as we kick off the middle of January, second week of January, everybody's back and the market is very much active. We have a very large list of events that are going to be available to you guys either via YouTube or via X. They will be streamed here. If you go on our YouTube channel, you will see some of the events today. So we have some live trading at 10:30 with Anne-Marie from Top Step. We also have a very, very good session for those who are interested in knowing how quant trading firms are trading and using data at 12:30. And then we also have a lot of different sessions throughout the week. We're back with Tim on Monday, and we have more and more sessions coming next week. So there's a lot here. Please, guys, follow us on YouTube so you stay updated with all the sessions. Help us grow the channel as well. That would be awesome. And let's see if we got more questions.
Yeah, and if you are maybe too shy to shoot out a question, you can do it on Discord as well if the people are listening or in the community as well. You can write me a message on X. Just pop the link into the commentary section. Yeah.
We have one from Joel. Tim, I don't know if you want to take this.
Oh, yeah. The Fed lowered short-term rates. However, can you going into why you think long-term rates 10-year went higher? So 10-year is the belly, right? It's not really that long. Long-term rates are 20 or 30 years. All the rates down the curve have sometimes the same drivers, but there's a little bit of a difference in it. Shorter ones, obviously, are tied to monetary policy, like 1 year or 2 year. That's the reason I mentioned the weird story with the 2 years are trading above the effective federal funds, and that they are in theory or in mathematical island, they are pricing in a hike in rates. So for the 10 years, they got Also, of course, driven by monetary policy, because the rate curve, is like a term structure in futures, right? It's always moving kind of equally. On the other hand, inflation goes down there as well, inflation expectations. And the other thing, and that's a little bit of a nerd topic because it tries to map out bond issuance. I don't know if you guys know, nearly every day in the US, the Treasury Department selling bonds to the public, to investors, domestic and foreign. And that's a driver there as well, because they can sell like sub 2 year, more 10 years, or more 20, or more 40 years. So it's a supply and demand thing over there, right? Do we have high supply? Do we have high demand? On the other hand, those yields are reflecting, especially in the longer end, the liquidity of the bond. So if bond yields are high, they are a little bit more illiquid. It's a little bit misleading because the bond market is very, very liquid, but also the credit outlook for the underlying economy. So this is something you can translate, of course, into the government debt ceiling. If we have a deficit or a surplus in spending, right? Those are the technical drivers behind it. But if you have enough nominal GDP growth in a country, elevated bond yield isn't that much of a problem. I know there will be a lot of chatting about the 5% area in 10 years over the next few days. But if people are making money, if real wages are higher, if people have jobs, if the economy is doing good, and you have quarterly GDP growth about how high they are, 2.8. What's let me cook a few seconds. Yeah, of course, Atlanta GDP 2.8 here. If this growth is in the market, it's not that big of a problem, because those low yields that we had in the past, that's not normal, right? 10-year yield down 2% or 2.5. That's the abnormal about this thing. Money can cost and should cost a little bit. But yeah, as you can see, there are very, very different drivers behind it. As for now, I'm not in the camp that those high yields are the main driver in equities, that they are down. I am more in the camp we had pretty high valuations. We had crowded positions, like in tech and other stuff. That's the reason I showed ARK earlier, right? The garbage tech index. If this stuff is performing pretty good, like it did after the elections and in December, it's always a sign people are very, very tied to the risk side of the market. And if you are jumping on a train that's already moving a few days or a few weeks, you have to pay more premium, right? If we have options traders in here, think about it. A big uptrend, calls are getting more pricey, so the IV is higher, and you have to pay more to bet on the outcome that this trend is ongoing. And that's the same in equity land. If you're trading physical, people have to borrow money, and the lender says then, right, okay, this market is running so high, you maybe have limited upside here. I have to charge you more, that you get money from me, that you can invest into the stock market. And this was pretty high in the end of 24. And I think that's more a thing in the market, that we are coming down a little bit. Volatility kicks in because people are sitting on pretty high returns from over the last 2 years, and they have protected this. So as for now, I'm not in the camp of a high yield is particularly the main driver behind equities.
Yeah.
So yeah, session recorded. Something for you, Fabio. Yes, on YouTube, of course.
Yeah. Yeah, we will add this to the academy as well. So yes, absolutely.
Christopher, do you recommend looking at the options on futures data or the options on the corresponding ETF, given the options on the ETF are much more greater in volume, or are both positioned the same? So do we talking about indices or yeah, in indice country, I always focus on the future options data. Also, if I trade ES and Q or whatever, I'm just using the MenthorQ options data from there. I think it's kind of a little bit of a thing what you're used to it. Of course, this stuff has different option chains, right? That's why prices are order or open interest maybe a little bit different over there. And yeah, for the commodities, I mentioned this earlier. With the special case in UNG, that's not a great performer because of the rollover losses due to the underlying. We have also the options data for the NQ for the NG future. They are pretty thin. That's the problem. So think about it. NG is a commodity that's not that great traded. There are small players down there. It's not like CL or GC. And so it's pretty thin. In theory, you could map out UNG options data and do a trade in the NG future, but it depends heavily on what's going on in this market. That's the problem. So I can't make a general stance over there. If, like in 23, where MenthorQ was pretty new, I also traded CL with USO data, but then I just focused on the important stuff, like areas where a big put exposure was, in the assumptions those puts have been bought and should act as a hedge. And then I mapped it out with CL and searched for entry down there to play the long side. I mean, it worked, but for me, the future options levels are working way better, to be honest. Yes, I'm online with a cam. That's pretty new, isn't it?
We made you buy it.
Yes. No Batman life for me anymore. All right.
Let's see.
53 minutes. That's good. I always try to keep it like an hour, okay? That we are not annoy you or have boring content in here. Just talk about the main stuff that's important.
Yeah, let's see if we have last few minutes questions. But I think, Tim, this was a great start, and we are very excited for the weekly session. So obviously, this was the first one. We're always gonna add value over the next few weeks. And please, guys, if you have any feedback, any things that you would like to be covered, please send it to us on Discord, via email, or just contact us directly.
Yeah, however, just see how you guys enjoy it or what you not enjoy it. Also, if you have some critical points that are where you say, oh guys, that's stupid or that's wrong, tell us. Open to everything. I mean, it's like a market. There's no wrong, there's no right, just bid and asks. So
yeah. Awesome. All right, guys. Thanks, everyone. So as always, if you are new to us, you can take a look at our website and join our mailing list. We're going to share all the events. You can also access all our free resources there. And then today we're going to have a very nice session here with Anne-Marie from Top Step TV. So we're going to do live trading with her and Patrick. So don't miss that. It's going to be streamed on YouTube and on X at 10:30 Eastern. So that would be awesome. And then we'll also have another session later at 12:30. So don't miss it, guys. I pasted the link here. You can find us on YouTube as well. So everything is there. And thank you so much, Tim. And see you again in the chat, and see you again next week.
Yes, thank you guys. I really appreciate that you tuned in today, whatever you come from. And yeah, have a nice week, and hopefully see us next Monday, okay?
See you soon. Bye.
Bye.